We're now going to look at the relevant cash flows, and we're going to do this in two stages. We're going to first talk about it from a theoretical standpoint in words, and then we're going to create an example. We're going to go through all these different cash flows we talk about, do the calculations, set up all the cash flows over the life of the project, and then we're going to use those cash flows as we talk about the payback period, net present value, internal rate of return methods as well. And so this is, as I've said before, the foundational part of capital budgeting. And if you don't get the cash flows correct, you've got a large problem. You're just not going to be able to get useful information out of this. And so we need to make certain that we understand what the relevant cash flows are so that we can filter out the ones that are not relevant, and then also how we go about calculating what the amount of those cash flows are and putting them in the right period in this whole capital project that we're looking at. So we'll start by looking at these relevant cash flows. Again, they are the revenues, the costs, the cash flows that are relevant because they are different between possible alternatives. We've got option A and we've got option B. We're looking at those cash flows that are different between the options, because if it's the same between all of the options, well, then it doesn't matter which option we choose. We're still going to have this cash flow, whether it's a cash outflow or a cash inflow. So we're looking for the things that are different, the cash flows that are different. Now again, we talked about the fact that there are two categories of relevant cash flows. There are differential cash flows and there are incremental cash flows. And the difference between differential and incremental is really kind of a technical one that's not relevant necessarily. But when we're talking about a differential cash flow, it is the cash flow that is the two options, between two options, option A and option B. And the incremental cash flow is that difference cash flow between doing something and not doing something. So between investing in project A and not investing in project A. All those cash flows connected to project A are incremental cash flows. When we're looking at project A and project B, those cash flows, the different cash flows between project A and project B, are differential cash flows. So we're looking here at those cash flows that are different in order to determine which cash flows are relevant. We also need to keep in mind that because we're going years into the future, we don't know for certain what the cash flows are actually going to be. And so what we use are the expected cash flows. We're going to calculate the weighted average of all the possible cash flows, whatever it is that we have, to come up with an individual number that goes into our analysis. We can't have a range of numbers in year 5. There has to be a number. And so we're going to use expected cash flows, however it is that we calculate that. Most of the times in a question it's just going to be given to us, but it is possible that we're going to have to, in creating an individual cash flow, be able to calculate that expected cash flow, which is just the weighted average of all of the different options that we have. Also, we assume that all of our cash flows take place at the end of the year. Okay, again, just kind of making the math a lot more simple for us. All the cash flows are taking place at the end of the year, except the cash flows that happen at the initial investment at time 0. But then the first year cash flows happen at the end of year 1, the second year cash flows happen at the end of year 2, and so on. And one other important note about these expected cash flows that we're using, all of the cash flows that we use in our analysis need to be after tax. And so what we're going to be doing here is we look at the different cash flows that we have. Some of the cash flows are not a tax event. So some of the cash flows don't have a tax impact connected with them, and some of them do. And so what we're going to have to be able to do is take an individual cash flow, determine what that amount of cash is that's going to be coming in or going out, but then also make certain we know whether or not there's a tax impact connected to that individual cash flow. And if there is a tax impact, how we go about calculating it. So as we look at all of the different individual cash flows, we'll also be noting whether or not there's a tax impact from those cash flows or not. And again, what we're going through here is the theoretical discussion of it. Okay, the next one we'll go through with actual numbers and examples, and so hopefully that will help bring this theory, what we're talking about here, into very specific, see how it works in action. There are 3 periods that we need to look at during the project. Those 3 periods are the beginning of the project, then each year throughout the project, and then the end of the life of the project, at the end of the project. Generally in a question, the cash flows that are in the second time period, the years throughout the project, so we're talking about 10 years perhaps. In a lot of questions, these cash flows are the same each year. In reality, obviously, that's not going to be the case. But for a question here on the exam, it's often just cash flows are going to be $15,000 a year for 7 years. All that's doing is making the math easier. Okay? We could, with the help of a spreadsheet, very easily, help of tools, very easily, have a different cash flow each month for 10 years. And the computer calculates all of that effortlessly. For us to do it on the exam, that's just a calculator exercise. And so in a lot of questions, the cash flows each year during the project are going to be the same. That just helps us make the math easier. It makes it an annuity, the present value of an annuity rather than the present value of 10 individual numbers. Okay, but we'll get to that as we go through net present value and some of the other methods that we're looking at. But we have 3 time periods. And so what we're going to do is we're going to look at, first, what are the cash flows at the start of the project? What are the cash flows every year of the project? And then what are the cash flows at the end of the project? And it's possible that you get a question on the exam about any one of these. They give you a bunch of information and then say, what are the initial cash flows? They give you a bunch of information and they say, what are the cash flows in year 6? They give you a bunch of information and then they ask you, what are the cash flows at the end of the project? So any one of these could individually be a question or could be combined using all of these cash flows in a larger question. But we start with the cash flows at the beginning of the project. What are the cash flows at the beginning of the project? And there are 3 of them that might exist. Not all of them are going to be in every question. But the first is the initial investment. Okay, we have to make an initial investment, and this may be the purchase of the fixed assets. Okay, we're buying equipment for our assembly line. We're buying a factory. We're building something. But there is an initial investment. Okay, for buying fixed assets, the setup, the transportation, the testing, all the costs of making this initial investment. There is a tax impact connected to this initial investment, but it's not now. It's not in year 0. We're going to see the tax effect of this initial investment throughout the life of the project in the form of depreciation. And we'll come back to this when we talk about the cash flows throughout the project. But the tax effect of this initial investment is done throughout the life of the project in the form of depreciation. The second cash flow that may exist, it doesn't always exist in every question, but may exist at the start of the project, is an initial working capital investment. Okay? Because we're expanding our production, sales are going to go up, which means we're going to have an increase in inventory, we're going to have an increase in accounts receivable, maybe accounts payable will go up a little bit as well. But overall, as a result of this project, working capital is going up. Now, from a cash flow standpoint, this increase in working capital is considered to be a cash outflow because we're buying inventory. Our receivables are going up, which isn't necessarily a cash outflow, but it's not a cash inflow. It's a loan that we've given to our customers. And so this increase in working capital is considered to be a cash outflow, but there's no tax effect for this. Okay, so whatever that increase in working capital is, that's going to be our cash flow. And as that increase happens, that's a cash outflow. Now, the third cash flow at the start of the project, it's possible that there is a disposal of the old machine. We're buying new equipment, so we dispose of the old equipment. So clearly, the cash we receive from the disposal of the old machine is a cash inflow. That's a good thing. But maybe a tax effect from this. When we sell the old machine, there's probably going to be a tax gain or a loss. And so if there's a gain, we have the pleasure and privilege of paying taxes, which will be a cash outflow. If there's a tax loss, well, that becomes a deductible amount for tax purposes somewhere else, which will actually increase. Well, it'll decrease the taxes we pay out for some other part of our profits, and we treat that as a cash inflow. we calculate the gain or loss on the sale of the old machine as the difference between the sales price of the old machine and the tax basis of that old machine. If there is a gain, that tax impact of the gain is a cash outflow. It's subtracted from the cash received. If we have a tax loss, that tax effect of that loss is added to the cash inflow because it's saving our tax money somewhere else. So, in the largest possible beginning of the project cash flows, there's the initial investment, a working capital investment, and the sale of an old machine. It's possible in a question that there is no working capital investment and there is no machine to sell, in which case it's just that initial investment. But these are the possible beginning of the project cash flows. The next time frame is the life of the project, during the project. And all of those cash flows from year 1 through year 7, 10, 15, whatever the case may be. One of the potential cash flows is increased sales. We sell more. This is a good thing. Cash inflow from our increased sales. This is a good thing. But we will have the pleasure and privilege of paying taxes on that. And so we have our increase in sales as a cash inflow, but we have to subtract out of that the taxes. Okay, we have to subtract out of that the taxes. One option is one benefit we have from our project is increased sales. It's also possible that we have decreased operating expenses because of our new investment. We're more efficient, more effective, whatever the case may be. Just like increased sales are a cash inflow, decreased operating expenses are also going to be considered a cash inflow. I understand that nobody's paying us this money, but we're decreasing the amount of money that we're paying out. And so the net effect is that it's the same thing as a cash inflow. And again, if we have decreased operating expenses, our profit will be higher, which means we will have the pleasure and privilege of paying taxes, and so we have to take taxes out of the cash inflow from these decreased operating expenses. A third possible investment, or cash flow, doesn't always happen, is another cash investment. It's possible that at year 3 we have to make a secondary investment. We have to make a large capital expenditure or something like that. Well, if we do, in whatever year we have this additional cash investment, it's a cash outflow, and the tax effect of this cash outflow is going to be, again, through depreciation. The fourth possible cash flow is there might be a further working capital investment. After 5 years, the project gets to full capacity and working capital goes up again. Same as it was before. That increase in working capital is treated as a cash outflow, and there's no tax effect to it. Very possible in a question that there is not a second investment. There is not a further increase in working capital. But if they're there, this is how you deal with them. And the final project cash flow, or cash flow during the life of the project, and this is the one that people have the most trouble with, is the Depreciation Tax Shield. Okay, the Depreciation Tax Shield. And this is where we see the tax effect of that initial investment and the tax effect of that second investment, if there is one. And here's what happens with the Depreciation Tax Shield. As we depreciate the asset, that depreciation expense becomes deductible for tax purposes. And because it's deductible for tax purposes, it decreases our taxable profit, which decreases the amount of taxes we need to pay. The Depreciation Tax Shield is not a cash inflow in the sense that somebody is paying us money. Nobody is paying us money connected to the Depreciation Tax Shield. But because depreciation is a tax-deductible expense, it decreases the amount of the cash outflow that we have for taxes. If somebody comes to you and says, would you rather somebody gives you $100 or your expenses get reduced by $100? to you, the net effect is the same. And that's what's happening here. The depreciation tax shield is not somebody giving us money, but it's a cash inflow because the depreciation tax shield reduces the amount that we have to pay for taxes. The calculation of the depreciation tax shield is very simple. It is the amount of tax depreciation multiplied by our marginal tax rate. What is the tax depreciation expense for the year? What is the tax rate for the year? That is the amount of cash savings we have because we are depreciating the assets connected to this project. The amount of tax depreciation for the year multiplied by the tax rate for the year. And we will see this in numbers when we do the example. Okay, we'll build this up with the example. We will absolutely see this. A couple of notes about tax depreciation. First of all, tax depreciation may be different than accounting depreciation. For accounting, we may use straight line depreciation, but for tax purposes, we use whatever the tax code requires us to use. If the information is available, we should use tax depreciation in a question. If they tell us what book depreciation is and what tax depreciation is, we should use tax depreciation because that's how we calculate our taxable income. And finally, in U.S. tax depreciation calculations, salvage value is not taken into account. Just the entire cost of the asset is going to be depreciated over the useful life of that asset. This is relevant if they give you specific information about U.S. taxation, which uses what is called a MACRS system, M-A-C-R-S, Modified Accelerated Cost Recovery System. But we need to use tax depreciation if we are given both tax depreciation and book depreciation. Again, we'll come back and look at all of this when we go through the example with numbers. The third time period of our project is the end of the project and the cash flows at the end of the project. The first of these is probably cash received from the disposal of the equipment. Okay. At the end, we sell it. Cash received, that's a cash inflow, but just like we had the tax gain or loss on when we sold the old equipment at the beginning, we have a tax gain or loss for selling the old equipment, or the new equipment, which at that point becomes the old equipment, at the end of the project. So that cash received from the disposal of the equipment is adjusted for taxes, just like we adjusted for taxes when we sold the original equipment. The second potential end of the project cash flow is the recovery of the working capital, the release of the working capital. When the project is over, inventory goes down, accounts receivable goes down, payables goes down. As that working capital comes down, as it recovers, as it's released, as the term is sometimes used, we consider that decrease in working capital to be a cash inflow because we stop investing cash in inventory. We collect those last receivables from our customers. So the recovery of the working capital is a cash inflow, and there is no tax effect. Okay? Just like there's no tax effect when working capital was built up, there is no tax effect when working capital is released at the end of the project as well. So those are the relevant cash flows. The cash flows at the beginning of the project, the cash flows during the project, and the cash flows at the end of the project. You need to know how to calculate all of those and what the tax impact is of each of those. Okay? The initial investment, that tax impact is the depreciation tax shield. There is no tax impact on working capital. But if we sell an asset, if we have increased revenues, decreased expenses, there's a tax impact of those. So we're looking for after-tax cash flows. So those are all the relevant cash flows. And right here at the end, I want to spend just a moment talking about some irrelevant cash flows that sometimes show up in a question. And what they're putting in this question is information you don't need to determine whether or not you're able to separate out what are the relevant cash flows from what are the irrelevant cash flows. One of the irrelevant cash flows is sunk costs. The cost of the old equipment. How much we paid for the old equipment. We don't care. We care about the tax gain or loss on the sale of the old equipment. We care how much cash we get for the old equipment. But how much we paid for it 7 years ago doesn't matter. Allocated common costs, not relevant. Okay, they're allocated. Whether we make this investment or don't make this investment, those common costs are still going to be incurred. And financing cash flows. The financing cash flows are a financing decision. Different departments making that decision about how we finance this project. We're looking at the cash flows that are connected specifically to this project, and it does not include the financing cash flows. So, relevant cash flows, irrelevant cash flows. Again, this is the foundation of these questions. These questions may come up simply as, what are the cash flows at the initial investment time period? What are the cash flows in year 4? What are the cash flows at the end? Or you may have to then calculate the cash flow and use it. So you have to make certain you understand what the relevant cash flows are, how we calculate them, and how we take into account taxes as well. So what we're going to do next is we're going to look at an example of all of this. We're going to build up all of these cash flows with numbers and come up with a nice table for all of the cash flows at the initial investment, the cash flows throughout the project, and the cash flows at the end of the project. And that's what we're going to do next.